All right, let's jump right into it. Yum China's Q3 numbers are out, and the market's reaction, well, let's call it a polite nod of approval. So what's really going on under the hood here, and what does it all mean for the stock? We're going to break it all down.
Okay, here's the game plan. We'll hit the numbers, dive deep into operations, check out what management is saying about the future, and then I'll give you our take on what comes next.
So first things first, let's talk earnings. Yum China came in with diluted EPS of 76 cents. And you know what? That's pretty much exactly what Wall Street was expecting. No fireworks, no drama, just solid, clean execution.
And what about the top line? Revenue hit $3.21 billion. That's a little bit better than the consensus, and it's up about 4.4% from last year. Respectable stuff.
So, how'd the market take all this? Well, the stock popped up just under 2%, about 1.91 to be exact. Look, it's not going to set the world on fire, but it's a clear signal that investors liked what they saw. It was a clean quarter, and they appreciated that.
All right, let's dive into the numbers. Look, the headline print is one thing, but the real story here is how they're pulling this off in what's, a pretty tricky consumer environment over there. Okay, so take a look at this. EPS, in line. Revenue, a slight beat. But the real hero of this quarter, it's that operating profit. $400 million bucks, up a very healthy 8% year over year. That, right there, tells you everything you need to know about their execution and how tight a ship they're running.
But we've got to put that little stock pop into perspective. If you zoom out and look at the past year, it's a totally different picture. Yum China has been seriously lagging the big China ETFs. I mean, look at MCHI and KWEB. So what does that tell you? It says the market is saying, yeah, we love how you run your business, but we're still really nervous about the whole China macro story.
So the big question is, how are they doing it? How are they putting up these numbers? Well, it all comes down to what's happening on the ground. Let's dig in. Okay, 1%. Same-store sales grew by 1%. Now, I know what you're thinking. 1%, that's it. But hold on. The how is what matters. This wasn't from jacking up prices. No, this was all from transaction growth. More people are coming in. That's a huge tell, especially when you know consumers are watching every penny.
And speaking of getting people in the door, they are building new doors at a crazy pace. We're talking 536 net new stores in one quarter. That's just wild. Their total is now over 17,500 stores. The scale is just immense.
And this really drives the point home. The CEO, Joey Watt, pointed this out on the call. 11 quarters in a row of transaction growth. Think about that. For almost 3 years, they've consistently gotten more customers to come in. That proves their whole playbook is working. It's not about price hikes, it's about volume, value, and keeping people coming back.
And here's the kicker. They're doing all of this while actually becoming more profitable. Restaurant margin went up 30 basis points. I mean, think about the pressures they're facing. Higher wages, customers hunting for deals, and they still managed to expand their margins to over 17%. That is just phenomenal cost control.
Now, let's talk about a huge piece of the puzzle, delivery. It's now more than half of their business, 51%. This is a fundamental change in how people are eating. And yeah, it comes with challenges, right? You've got those delivery fees that can eat into margins. But at the end of the day, you have to be where the customer is. And right now, the customer's on their couch.
Okay, so that's the what happened. But what about the what's next? Let's look at what management is signaling for the future.
And the message from management is crystal clear. Full steam ahead. They're sticking to their guns on all their big targets for the year. We're talking a massive number of new stores, between 1,600 and 1,800, and they're still planning to hand back $1.5 billion to shareholders. You just don't do that unless you are extremely confident in your business.
And I think this is really smart. They're not treating their brands as a monolith. They have this two-pronged attack. For KFC, the crown jewel, it's all about protecting the brand, being innovative, and holding the line on price. But for Pizza Hut, they're in turnaround mode. They're using value and lower prices to drive traffic. And what's amazing is that it's working so well that they've actually expanded Pizza Hut's margins for 6 straight quarters while doing it. Super impressive.
And the CEO kind of put a bow on all of this with this quote about their RGM strategy. It stands for resilience, growth, and moats. And look, I know it sounds like corporate speak, but it's actually a pretty good summary of what they're doing. Stay strong, keep growing, and protect your business. It's the simple playbook they're using to navigate a really complicated environment. Okay, so we've looked at the quarter, we've looked at the operations, we've heard from management.
Now for the million-dollar question, what does it all mean for the stock? Let's get to our take.
All right, here's our call. We're rating Yum China a market perform, and the logic here is pretty straightforward. On one hand, you have a company that is just executing flawlessly, A-plus stuff. But on the other hand, you can't ignore the bigger picture. The China macro story is still a huge question mark, and the stock just hasn't been able to break out.
So what should you be watching for heading into the next quarter? Well, on the bull side, you want to see that transaction growth continue. That's the key catalyst. And you want to see them hit that massive new store target. On the risk side of the ledger, it's really all about the Chinese consumer. If they pull back, or if competition heats up and the holiday promotions fall flat, that's where you could see some trouble.
So, how do you play this? Here's a trade idea for you to think about. A pair trade. You go long YUMC because you want to bet on their best-in-class execution. But you hedge out that broad China risk by going short something like the KWEB Internet ETF. What this does essentially is it lets you bet on the company itself while trying to insulate yourself from the bigger, messier economic picture.
And as always, just a reminder, this is not financial advice.